There's a specific moment that decides whether a car purchase turns into a smart financial move or a quiet money leak. And it happens before anyone even starts the engine. It happens the second someone checks the box for lease or loan on the paperwork. Everything that follows, every dollar spent, every dollar recovered, every year of feeling ahead or feeling behind, traces back to that one signature. Here's how that single choice plays out over 6 years for two ordinary guys who bought the exact same car. Michael and Jim are co-workers, both 32, both making roughly $58,000 a year, both living in the same mid-sized city with similar rent, similar student loan balances. They end up at the same dealership the same week, both eyeing an identical $32,000 SUV. Same color, same trim level, same finance manager walking them through the paperwork. What splits their financial paths over the next 6 years is a single line item on the contract, one they each barely thought twice about at the time. Michael signs a 3-year lease, $2,500 due at signing, $319 a month after that. It's pitched to him as the obviously clever move, the smallest possible payment, a warranty that covers nearly everything that could go wrong, and the option to simply walk away when the term ends without another thought about the vehicle again. Jim instead finances the same SUV over 6 years at 6.5% interest. He puts $4,000 down and pays $470 every month, still $151 more than Michael's payment, month after month for years on end. On paper, in that dealership, on that first afternoon, Jim's decision looks like the more expensive one by a wide margin. On the surface, this looks like a blowout in Michael's favor. His monthly obligation is smaller, his bank account looks healthier from day one, and anyone glancing at these two numbers side by side would call the decision before either of them had even left the parking lot. That's the trap. The comparison that matters isn't the one you can make in the first 5 minutes. Two very different transactions wearing the same disguise. Here's what that quick glance misses entirely. Michael and Jim aren't actually buying the same thing, even though they're driving the same car off the same lot on the same day. Michael's $319 a month is paying for temporary access, a subscription to a depreciating object that was never going to belong to him. Jim's $470 a month is slowly converting into ownership, one payment at a time, whether he thinks about it that way or not. It doesn't feel that way in year one, when his loan balance still towers over the SUV's resale value, and every payment seems to vanish into a hole. But that structural difference, rental versus ownership, dressed up in nearly identical monthly numbers, is the entire reason their financial outcomes diverge so sharply by the time 6 years are up. It's the difference between paying for the use of something and paying to eventually possess it outright. Year one, the lease looks unbeatable for Michael. The first 12 months are close to worry-free, and it's easy to see why leasing has such an appealing reputation. A dashboard warning light flickers on, gets diagnosed, gets fixed, covered under warranty, no charge. The infotainment screen glitches and needs a software reset, covered. The AC compressor quits in the middle of a July heat wave, the exact worst possible timing, covered, no questions asked. His monthly costs never move. Lease payment, gas, insurance, and nothing else. No surprise bills, no anxious trips to the mechanic. No wondering what a strange noise under the hood might cost him. Jim's first year is rougher. At least on paper, the SUV loses roughly $3,500 in value the moment he drives it off the lot. That's just the nature of a new vehicle crossing into used the instant the title changes hands. By month 12, it's worth around $27,000, while he still owes close to $27,800 on a loan. For a stretch of several months, Jim technically owes the bank more than the car is actually worth if he sold it tomorrow, an uncomfortable spot to sit in, and exactly the reason most people assume financing is the losing strategy right out of the gate. Add up year one. Michael has spent $6,328 total, down payment plus 12 monthly payments. Jim has spent $9,640. A gap of over $3,300 already, and it would be entirely reasonable for Jim to look at that number and wonder if he made the wrong call. Years 2 and 3. The gap narrows, then holds by year 2. Michael's costs stay perfectly flat, still $319 a month, still nothing unexpected, still that same sense of ease. Jim's loan balance, meanwhile, keeps dropping with every payment, and the SUV's depreciation curve starts to flatten out the way depreciation curves always do after the first steep drop. It's worth roughly $23,000 by the 2-year mark, while his loan balance has fallen to about $24,300. He's nearly at break-even on paper, and psychologically that matters more than the numbers alone suggest. The feeling of being underwater starts to lift, even before the math officially turns in his favor. Year 3 brings the real fork in the road, the moment where the two paths genuinely start to separate rather than just running in parallel. Michael's lease matures at month 36, and he's handed 3 choices. Buy the SUV outright for its locked-in residual value, typically somewhere between $17,000 and $19,000 for a vehicle like this. Return it and know nothing further, or sign a brand new lease and reset the entire clock. The overwhelming majority of lessees, Michael very much included, picked door 3. A new $2,500 signing fee, a new $319 monthly bill, a brand new 36-month term, starting all over again from zero. Jim isn't facing anything like that decision point. He's exactly halfway through a loan that's actively shrinking, with a defined ending date, still 3 years out but real, circled, and getting closer with every payment. There's no renewal decision to make, no new contract to sign, nothing resetting. The path just continues. Tally the first 3 years of spending. Michael is out $14,184 total. Jim is out $20,920. That's a $6,736 gap, still solidly in Michael's favor, which is exactly the point where most casual comparisons stop looking and confidently declare leasing the smarter financial choice. If this were a 3-year story, that conclusion would even be defensible. Year 4. Michael starts over. Jim keeps going. This is where the story quietly begins to turn in a way that doesn't announce itself with any single dramatic moment. Michael is now several months into his second lease, still paying that same $319 a month. But he's also just paid a second $2,500 signing fee, money that disappeared the instant he handed it over, buying him nothing but the right to keep making payments on yet another car he'll never own. Across 2 lease terms, Michael has now put down $5,000 total just in upfront fees alone, none of which builds toward anything at all. It simply funds the privilege of restarting. Jim's 4th year looks structurally identical to his 3rd and 2nd, same $470 payment, no new fees, no reset, nothing changing about his monthly routine except the loan balance quietly getting smaller. His balance drops to around $17,500, while the SUV itself, now 4 years old, is worth an estimated $19,000. For the first time since he drove it off the lot, Jim's asset is worth more than what he still owes on it. That's the moment ownership genuinely starts working in his favor instead of against him. And it happens without any paperwork, without any dealership visit, without him even necessarily noticing the exact week it occurred. Year 5. Michael has spent a full 24 months into his second lease. His combined 2 lease total sits at roughly $23,036. He still owns nothing at this point, no equity, no asset, just a stack of paperwork from 2 separate 3-year contracts, and 18 more months remaining on the current one before he'll face the exact same decision all over again. Jim, meanwhile, has just 11 payments left on his loan, the finish line clearly visible now. His running total sits at $28,270, but his SUV, now worth around $16,000, is closing the effective gap fast. Net his asset value against his total spending, and his true cost so far comes out to roughly $12,270, compared to Michael's $23,036 spent with absolutely nothing to show for. The lead has fully changed hands by this point, and it isn't a close race anymore. Year 6. The finish line. Jim makes his final loan payment sometime during year 6. The bill disappears completely, permanently, for good. From that point forward, his only car-related expenses are fuel, insurance, and routine maintenance, typically $110 to $170 a month for a vehicle in this class once you average out oil changes, tires, and the occasional repair. Michael is still writing that $319 check every single month, now well into his second lease term, and it barely registers as a decision anymore. It's become a fixed expense, the way a phone bill or a streaming subscription is something that happens automatically rather than something he actively chooses and reconsiders each month. Add up the full 6 years for both men. Michael has spent approximately $27,970 across 2 complete lease terms. His return on all of that spending? Nothing. No title, no equity, just 2 sets of expired paperwork, and if the pattern continues the way it has for 80% of lessees, a third lease already beginning right where the second one left off. Jim has spent a total of $32,400 across his 6-year loan, including the original down payment. But he now owns the SUV free and clear, and it's worth an estimated $12,000 to $14,000 on the used market. Subtract that from what he spent, and his real net cost comes out to somewhere between $18,400 and $20,400. Line them up side by side. Michael, roughly $28,000 spent, 0 assets, 0 equity, a monthly bill that will continue indefinitely for as long as he keeps this pattern going. Jim, an effective cost of roughly $19,000 to $20,000, plus a fully paid-off vehicle sitting in his driveway that he can drive, sell, or trade whenever he chooses. Somewhere between year 3 and year 6, without either of them consciously noticing in the moment, the financial advantage quietly swaps sides. And every month that passes after this widens that gap even further in Jim's favor, because his costs are about to drop to nearly nothing, while Michael's never will, not as long as he keeps releasing. What's buried in the fine print, the advertised monthly payment, is only ever part of the deal. Here's what typically isn't printed anywhere near it, tucked instead into pages of contract language most people skim past on signing day. Mileage restrictions. Most leases cap annual mileage somewhere between 10,000 and 12,000 miles, but the average American driver logs closer to 13,500 miles a year, meaning a large share of lessees are already over budget before the lease term is even up. Overage penalties usually run 15 to 25 cents per mile, so driving 5,000 miles over across a 3-year term can mean a surprise bill of $750 to $1,250 the day the car goes back, a bill that arrives all at once, with no warning along the way. Condition assessments. Dealers inspect returned vehicles for anything beyond what they define as normal wear, and that standard is set entirely by the leasing company, not the driver who's been living with the car every day. A parking lot scuff, a small stain on the back seat, curb rash from one tight parallel park, any of it can turn into an unexpected charge nobody flagged clearly at signing. Turn-in fees. Returning a lease without immediately signing another one from the same manufacturer often triggers a disposition fee, typically $300 to $500, just to process the return of a car that was never actually his to begin with. It's a fee for giving something back. Limited exit options. If life circumstances shift mid-lease, a move, a layoff, a change in family situation, anything unpredictable, breaking the contract early can mean owing the entire remaining balance of the lease in one lump sum. There's rarely a low-cost way out once the signature is on the page, which turns a flexible-sounding arrangement into a fairly rigid one. None of this shows up in the $319 figure. It shows up later, usually all at once, and usually at the least convenient possible time. Ownership has its own rough edges, to be fair. Buying isn't free of surprises either. It would be dishonest to pretend otherwise. Once the factory warranty expires, usually around year 3 or 4, every repair bill lands squarely on the owner with no manufacturer safety net left to catch it. Brake jobs, timing belts, a failed AC compressor in the middle of summer, all of it becomes Jim's responsibility alone. Post-warranty maintenance on a vehicle like this typically runs $1,300 to $1,900 a year, and it doesn't arrive in even predictable installments. Some years it's just tires and oil changes. Other years, it's an unplanned $2,200 repair that blows through the monthly budget in a single afternoon and forces some uncomfortable trade-offs elsewhere. Depreciation is real too, and no amount of careful financing erases it. That $32,000 SUV might be worth around $23,000 after 2 years and roughly $16,000 after 4. But the rate of loss slows down considerably after the first couple of years, which is exactly why Jim's break-even point arrives faster than most people initially expect. The steepest part of the depreciation curve is already behind him by the time he crosses into positive equity, meaning the vehicle stops actively working against his net worth relatively early in the ownership period. Where leasing actually makes sense, none of this means leasing is universally the wrong move for everyone in every situation. Business owners can often deduct lease payments partially or fully depending on how the vehicle is used, and that tax advantage alone can erase, or even reverse, the math laid out above. Anyone drawn to a vehicle where out-of-warranty repairs are genuinely punishing, certain luxury or performance models especially, where a single brake job can run into 4 figures, benefits meaningfully from staying under warranty for the vehicle's entire useful life, rather than absorbing 5-figure repair bills out of pocket. And someone with real discipline, the kind who would actually invest the monthly savings from leasing rather than simply enjoy having extra room in the budget, could theoretically come out ahead over time. The honest caveat is that fewer people follow through on that discipline month after month for years than assume they will when they're standing in the dealership. Both sides, laid out plainly, leasing offers a smaller upfront cost, a predictable fixed payment that never fluctuates, full warranty coverage for the entire term, and a new vehicle every few years without ever having to deal with the used car market. It's trade-offs. No equity is ever built no matter how many payments are made. Mileage limits carry real and sometimes substantial financial penalties. Wear and tear standards are subjective and defined by someone with a financial incentive to find issues. Turn-in fees apply at the end of every single term, and the payment effectively never stops if the lease keeps getting renewed every 3 years, which is what happens for the large majority of people who lease once. Buying offers an actual finish line where the payment disappears for good, full ownership of a real asset that can be sold, traded, or simply kept running for years after the debt is gone, and complete freedom from mileage caps or condition inspections. It's trade-offs. Higher monthly payments in the early years, unpredictable and sometimes significant repair costs once the factory warranty lapses, and the psychological discomfort of owing more than the car is worth during that first uncomfortable stretch before the balance and the value cross paths. The bottom line at year 6, high annual mileage tends to make leasing expensive fast, once overage penalties start piling up across years of driving more than the contract allows. Enjoying a new vehicle every few years and treating the added cost as the price of that particular experience is a legitimate lifestyle choice, not automatically a financial mistake, provided it's made with open eyes about what it actually costs long-term. Holding onto a vehicle for 6 years or longer almost always favors buying, since the debt-free stretch at the end is where the real savings show up, and that stretch arrives faster than most people expect once depreciation slows down. And genuinely investing the monthly gap between leasing and financing, not just planning to and never quite getting around to it, is really the one scenario where leasing can hold its own against ownership over a comparable time frame. What year 7 would look like, it's worth glancing 1 year past the finish line, because it clarifies just how lopsided this becomes if the pattern continues. In year 7, Jim's only expenses are gas, insurance, and maintenance, likely under $2,000 for the entire year, assuming nothing major breaks. Michael, still mid-lease on his second term, is on pace to pay roughly $3,828 that same year just to keep driving a car he'll never own. That's not a one-time gap. It's the new normal for as long as Michael keeps signing new leases, and it repeats every single year going forward, compounding the 6-year advantage Jim has already built even further. Michael and Jim both felt confident about their decision on that first afternoon at the dealership. Michael believed he'd found the more efficient path, the one that left more cash in his pocket every single month. Jim believed he was slowly building something real, even when the early math made that hard to feel. Neither of them looked past the first year of payments to see how the full 6-year story would actually unfold, which is exactly what most people do when a decision this size gets reduced to a single monthly number on a worksheet. The real takeaway isn't that one option is universally right and the other universally wrong. It's that a $32,000 decision deserves a longer look than the monthly figure printed on the sticker. Run it out 3 years, 6 years, or across a lifetime of repeating the same choice every time a lease or loan comes due. And the right answer for your own situation usually becomes obvious well before the finish line actually arrives.